Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast.
Welcome to the Expert Network Team podcast. I'm Karl Frank, and with me today I've got Nathan Merrill. Hi, Nate.
Your friendly neighborhood tax attorney. Yes, I'm here.
And you've got a great horror story for us today from the friendly neighborhood tax attorney.
Yeah, you could call it like more of, it's almost PTSD, because for me, this is the worst tax situation, and mainly because it deals with, I'll set this up a little bit if you want me to.
Please, yeah,
So
I want to hear the whole story.
Most people, when they think of tax attorneys, they think of their own tax obligations, right? Their income tax. This is mainly where I spend most of my time is tax efficiency planning, getting structures and strategies set up so that whether it be wealth transfer or income tax, for affluent families and or, successful businesses, that sort of stuff. I have strategies that deal with tax efficiency on all those realms. So there's another tax that we as business owners are confronted with that we don't normally think of as a tax because it's technically not our tax, and that is the employment tax.
Yeah, we've got to collect taxes for our employees every single paycheck, don't we?
Yep. And they refer to these taxes as trust fund taxes.
And I refer to them as payroll taxes, but tell me what they are.
Well, the reason they're referred to as trust fund taxes is technically they go into that lockbox back in Washington, D.C., and they're never touched because it's in a trust, and that trust is held for us and or our employees. And as a collector of tax for the trust, you are a fiduciary. So this isn't like you as a taxpayer having your own obligation to pay the tax. You are a fiduciary acting on behalf of the federal government to collect and remit taxes to the trust.
Ouch.
Yes. And so what happens here and where it
seems like I ought to get paid for that. It seems like the government ought to pay me for their fiduciary obligations before you even get into
that's
the
a
horror.
Pandora's box for me. The things that we should get paid for helping create tax revenue, right?
I mean, all the responsibilities on business owners. It's just horrible.
Yes, and this is also withholding, generally speaking, is the dirty little secret of tax for most of America. Most of America, they look at their net paycheck. They don't even
appreciate it.
Yeah, they don't realize how much the government's taking until the very end of the day when they're filing their taxes. So they get kind of numb to it, mainly because they have charged you and I, Mr. and Mrs. Employer, as their tax collectors.
And it's so complicated. Your average rank and file employee, I think about the young people that we hired this summer, and this is the first time they've ever had a paycheck. And they, let's say it was $1,000 and their net, they're bringing home $800 or something. And like, where'd the money go?
Well, talk about complicated. Most of your business owners, and this is an excellent transition to what we're going to be talking about, is most of your business owners don't want to have to deal with the minutia of calculating the proper withholding, doing the returns, and filing it. So what do we do? What do we do as employers?
We hire a payroll company to handle the problem.
Right. So if you're not using a PEO, which becomes the employer for tax purposes, you are usually outsourcing your payroll to a payroll company.
Right. Some sort of a service that provides it for you. They're computer automated.
Conceivably, and this is where I think some of the danger lies, which we'll get to, kind of some fact pattern risks that people should be aware of. But I believe Quicken has Intuit has a payroll service that you can use. We used it at the outset at our firm as well when we had like 3 employees.
Yeah.
But it gets more and more complicated, especially if you're operating multiple businesses or multiple sites that you have broken up into different
And then all these
payrolls and
different
stuff like
states you could have problems with.
Right. that. So this is a very complicated issue, and so problem number one, or scenario number one, case study number one,
Yes.
which we'll go to, is those who employ the use of payroll tax services. Karl, do you want to talk about what some of the risks might be here?
My horror story was awful. So we had a payroll company, and they were maybe $1 cheaper than whatever the company is next door. So we thought we'd use them, and we did. We successfully used the payroll company for years. They had a nice website. They're based out of California. When we're in Colorado, obviously, and it seemed like it was going along pretty well. We never had really great service, but it got the job done, right? We didn't have to do any of the calculation. They withheld the taxes, so we'd send them the taxes, and then they were supposed to send them to the federal government and the state government on our behalf. And lo and behold, one payroll comes along. This is several years ago, more than 5 years ago, and our employees never got paid. So we panicked, right? They get paid on Friday. They didn't receive their money. The employees are very kind to us and give us figured out on Monday. Nobody answers the phone at the payroll company on Monday.
That's a nightmare.
It was horrifying. Well, what we found, so we had to rewrite the paychecks for everybody on Friday. The following Friday, they gave us a week, and our employees are very kind. And lo and behold, the guy ran away with our money. So this payroll company, they're very loosely regulated payroll companies. What we learned, it's not
Back then they were for sure. Now they
goodness.
actually have to get registered, and the reporting requirements have changed because of situations just like yours.
Thank goodness. This guy he took several $1 million from all of his clients. We all got an FBI agent who we never met. He only sent out a blank email to all of us that looks like one of these phishing emails, and you don't even know if it's real, but it was real. And the guy did get caught eventually, but it was years later. He did do some jail time, and I think he's already done serving his jail time. And all of us never got our money.
And the important thing here to call out, because this is going to be a common thread throughout most of what we talk about today, is not only, for obvious reasons, he absconded with the payroll.
Yeah,
you had to come up with the money and fill that in.
That was salt in the wound, right? So
Right.
so we had to pay our employees twice, right?
Right.
That stinks. So there's, instead of 52 weeks in the year, right, there's another 54 weeks in the year. We had to pay an extra paycheck for everybody. And of course the owners eat that, no big deal. But what we didn't realize was that he also took the tax money.
Right.
And you're supposed to be, and he had been collecting all of the tax money, all of these pay periods through the quarter. He just kept all of it, never paid it. And now the employer, us, we were responsible for paying all the payroll taxes all over again.
So this is one of the key things that people need to be aware of, is even if you're contracting with a payroll company and you've remitted all the money to them, if they fail to do their duty, even if your contract says we're on the hook for this as the payroll company, you're on the hook for it still.
You're on the hook, personally liable.
As the trustee of those funds, you are 100% always liable for those. And we'll talk a little bit about who that translates to on the company side, because that's also an important consideration when you talk about setting up businesses and who's got authority to do what and that sort of stuff, and what kind of oversight there is. Because sometimes less is more in this construct, and I'll explain what I mean by that later. But in your case, you thought you had it offloaded to someone else. You weren't even thinking about it until it didn't happen, and now you realize you can't even say to the IRS, see, here's where it says we were getting them to do it.
Right. Yeah, no,
they're like, we don't care. It was your obligation.
Yeah, so we had to pay all that plus the late penalty.
Yep,
no excuses. Sorry, you're out of luck. This is your obligation. You
Right.
got to pay it.
So just a quick update for your benefit on the way this payroll system has gone. There are now basically separate reporting requirements. So what used to happen, and this is also applicable to PEOs, but when they file, obviously when they're just handling the collection and deposit, every 940 and 941 gets filed separately anyway. But when you're on a PEO, because the same thing can happen on PEOs, where you have employees for
So
business,
let's take two steps back. A PEO stands for
professional employment organization,
and they're different from a payroll company
because they are not your employees, technically speaking. They're state law your employees. They are for federal tax purposes viewed as the employees of the PEO.
Got
the PEO reports them all to the IRS on their payroll. So what was happening with some of these PEOs, and it's the same fraud basically is you would pay your deposit, or they would bill you for your employees. You'd pay the payroll company, and then they would file all those together. But what would happen sometimes is and this could be what triggers some of the payroll agent processes too, is someone doesn't give them the deposit, or one of their other customers doesn't pay them enough, or the check bounces, or NSF, insufficient funds, comes back, and they basically rob Peter to pay Paul, and then try to go after Paul to get Peter paid back, and it ends up becoming this big mess because
terrifying.
It's just a big slush fund. So now they basically, I believe they require bonding for these companies, so that if there is an issue,
well, that's good.
There's recoupment, right? Because too often, yours is not an isolated circumstance. Too often, these companies were just too shoddily run to actually be, and they were just shafting a bunch of people. So,
oh my goodness.
So that is case study number one. Is if you're going to offload your payroll, recognize that you have not offloaded the liability.
You've really offloaded the busy work,
right?
Of calculating Sally Jane's. Her payroll taxes, maybe her health care benefits, life insurance, any other benefits, that all those calculations and all those things can be done by a payroll company, but you're still liable for those taxes.
But every once in a while, if you're, you usually will see the money come out of your, if you're not doing EFTs directly to the government and you're transferring it to their account first and they're remitting to the government, every once in a while you will want to see receipt of your deposits being made. So that would be a little due diligence on your part, just to spot check it every once in a while. Don't just trust it's happening, because you can imagine what this looks like. Yours was a quarter.
Oh yeah.
Imagine if they hadn't absconded with the wages and you didn't know that the taxes weren't being paid.
Oh my gosh.
How long that could have gone on, which leads us to case story number or case
could have gone on for a whole
2.
year. Yeah, that's exactly right. What a nightmare. What a nightmare.
Any thoughts that you want to wrap up case study number 1?
Closing thoughts. I mean, these payroll companies make a fortune off of the carry, so they're going to pay the federal government and your employees, quite frankly, as late as possible. And I think everybody using a payroll company or a PEO knows that you have to pay on, let's say, Wednesday, and your employees get paid on Friday. That would be a very short amount of carry that they make, but they make interest off of their money there, and so probably maybe for these honest companies, that's where perhaps maybe some things could go wrong, is that maybe they actually lose timing, or they lose interest, they lose money on their investments, or whatever happens there. Perhaps maybe that's what happened. And in the case I'm talking about, it was blatant theft,
right?
So be wary, buyer beware when you buy a payroll company.
Yeah, absolutely.
Or a PEO.
So case study number 2, and this can manifest itself in a couple of different scenarios. So I'll give just a few of the hypotheticals. You go into business with your longtime friend. He needs some capital partners. You've got the capital, and you say, hey, buddy, let's go into business 50-50. You run the thing and make me a bunch of money,
and
right?
I'll just give you the money.
Right.
Sounds like a dream.
There's that.
What could go wrong?
The second hypothetical is you are transitioning your business to a new generation.
Oh.
And so you have relinquished control, but you may still have ownership, or a phased-in buyout or something like that.
Right. Yeah, it's just taking time.
Or you're just a passive investor in a business that your best buddy introduced you to. So you have a passive interest in a company. So now I'm going to kind of tease out this fact pattern.
Yeah, question on that. Does that mean I could be a limited partner?
Correct. Limited partner, a member in an LLC. The problem is not as pronounced in a stockholder situation, generally because it is more apparent that a stockholder typically has no direct involvement in the company.
So I could own shares of a C corporation and
Correct.
not be subject to the same liability.
Correct. It's going to depend. And what it's going to depend on, so when it comes to payroll tax liabilities, 2 conditions, or liability for payroll taxes, 2 conditions have to be satisfied. You have to be what they refer to as a responsible person. That's not getting to whether you pay your...
Whether I've been good.
Being good, or paying things on time, or, showing up on time. That's not that kind of responsible. The kind of responsible we're talking about here, I'll explain a little later, but it's basically with any sort of what we generally referred to in the legal community as a parent authority. They will look at anybody who even has the slightest indication of authority controlling financial matters. There are certain indicia, characteristics they look at to determine whether that a parent authority is actual authority.
One of those things that you know it when you see it.
Right.
Yeah.
But a stockholder, as an example, because we'll get into
generally
the
speaking,
authority.
I have no share. Right.
As a stockholder, you don't control anything. You can't call up and you can vote. Right.
Yeah, that's about it.
And generally, as a passive investor, just keep in mind that's where you want to be. So when you're reviewing your investment documents, you don't want to have any. And this is where, if investment documents or entity documents are shoddily drawn up, you can find yourself in a situation where you're like, someone used a member-managed form, and all of a sudden members are endowed with all the authority to operate the business.
You thought you had no authority, and if something were to go wrong...
They look at the IRS looks at the operating agreement, says here you're a member, and this is a member-managed entity. We're gonna at least start by coming after you and let you guys fight it out as to who has responsibility.
So rules number one are really understanding the limits of your liability as you go into a business.
Yes, and don't... this is one of those areas where it's kind of something to be aware of. I don't want to suggest that you never invest in a private enterprise, but just be aware that if the more control that you gain in terms of approving expenditures, in terms of capital deployments, that even though you're not in a position to actually cut those checks, if you are involved in the decision-making process, the IRS might come after you, and I'll explain why. Because the second condition that has to be satisfied is essentially an awareness that the tax liability existed, meaning it wasn't being paid, and willfully not doing anything about it. So if you're on the board of directors and you've become aware that there's a tax liability that isn't being paid, and even though as a director you're not responsible for cutting those checks. It's the CFO's responsibility, the president's responsibility, not the director's. But the IRS can say, but you should have done something about it. Yeah, that's how crazy this is and how far-reaching it can get. And that can get into, sadly, it can get into people who are just employees of the company. If they have knowledge and authority, that authority has been given to them to make these payments, IRS can come after them. So here's where it gets a little, some of the fact patterns get a little sticky. So client, is there something you wanted to interject?
No, I'm excited to find out what this case study is and what in the world happened to this poor person.
And I've seen a variation on this theme too many times for me to be quiet any longer. I need to take this public service announcement to the world. So that's why we're talking about it.
Yeah.
But in this particular fact pattern, and again, everyone can say this will never happen to me, but that's what this poor gentleman thought also likely, is that his business partner, his longtime friend, his college buddy, something snapped in the guy, and he just starts spending all the money that's coming in on other stuff, taking trips.
He blew it.
And he wasn't paying. I think he was paying payroll because the business was still running,
right?
But he was not making the tax deposits.
Oh my goodness!
Switched accounting firms. This is another telltale sign. Is someone when they start doing this, will say, "Hey, we're switching accounting firms," but they'll never onboard the new accounting firm, so nobody's looking over their shoulder, which is what happened in this case.
Oh dear!
And then come the middle to end of the summer. This is after COVID. Client is alerted because he's on the bank accounts by the bank that the accounts have been frozen because they haven't been paying their bank loans or whatever.
Oh no.
And so then he starts looking into it and he finds out all this misappropriation has been going on. Keep in mind that up to this point he is just a member.
Right.
So he's a member in the same sense that a stockholder is a stockholder.
So he invested dollars.
He invested dollars, but he was not on.
He's not
didn't have signing authority.
He
didn't have designated. He wasn't a manager of the company.
And how long did it go before the bank called him?
About 8 months.
Oh dear!
But he had gotten PPP, EIDLs, all
these
sorts
government
of
programs
stuff.
during COVID.
Right.
All these free loans from the federal government during COVID.
So this guy was awash in cash that he was not paying to the proper people. So rightfully, and you might think this is the appropriate natural instinct of this individual, he starts a temporary restraining order to get this guy out of control of the company because he's doing bad things.
No kidding. Don't let him do any more damage.
Right.
Protect the company.
Problem is, we now have this, who knows how large, they still don't know how large the tax liability is because they're having to reconstruct financials for 2+ years. He has now stepped into the shoes as the person managing the finances of the company. So the IRS is generous enough to say, hey, we're not going to hold you responsible because he's not responsible. He wasn't in a position of authority to actually do anything. He wasn't aware until he got the TRO, and then he got the TRO, and then he steps in as the manager of those financial accounts. Well, it's not as intuitive as you might think. The IRS doesn't draw a line in the sand there and say, okay, all that previous stuff belongs to him, and as long as you comply going forward, we won't hold you responsible for the back. That would be the logical conclusion, right?
It seems fair.
So the IRS doesn't view it that way. They basically say you have to keep the business going, but any discretionary cash has to be paid to us.
Oh, my goodness.
And to the extent you don't use unencumbered cash to pay that back liability as the new trustee, we might potentially hold you liable to the tune of how you've spent that discretionary funds going forward.
Goodness.
So basically the IRS imposes themselves as a senior creditor and has right to all the unencumbered cash in the business. Right. So he steps in not knowing this and now has been operating the company, which has been struggling for, let's call it, maybe it was last year. It may have been a full 18 months before he found out about this, but I'm trying to remember the exact fact pattern. But regardless, he's been operating the company, gradually shutting down.
He's in business
sites
with Tony Soprano. He's got the IRS Tony Soprano agent.
Right, and he can't resolve anything with his business partner, supposed partner, until April of 23 because courts are that slow right now.
Oh my gosh, what a nightmare.
So he almost would have been better off to just simply wash his hands of this investment.
Right.
Lick his wounds. He's going to have to declare bankruptcy probably anyway because of bank debt and
terrible.
Lease obligations. But at least those are dischargeable. Here's the final, strand of the whip, so to speak, that gets the taxpayer, the business owner, for doing this noble duty of collecting employment taxes. They're non-dischargeable in bankruptcy.
So he's going to be bankrupt after this.
And still have whatever potential tax liability he carries forward because he stepped in to try to save the day.
Which could be pretty substantial.
Could be.
I mean, 8 months is, we're talking...
It's all going to depend on how much unencumbered cash he had going forward after the fact.
Oh, my gosh.
But I've had cases where that unencumbered cash functionally equaled the original amount of tax.
And so then the IRS just says you owe all of it.
Yep.
So you're bankrupt plus whatever that is. Good luck with that. What a nightmare.
Yeah, well, then you're running into collection statute limitations of either 10 or 20 years, depending on how they proceed. 10 years if they never take you to litigation. If they go and get a judgment against you, it could be 20 years.
Terrible.
That could be hanging out over your head.
Oh, my gosh. What a nightmare for that poor person.
Yeah. So want to talk about a few of the things, the characteristics of a responsible person, if you think you've got a few minutes, just to highlight a few of these, because they're not necessarily intuitive. There's obvious ones.
Yeah, how does this work?
So responsible person is a facts and circumstances test, which basically means the IRS will decide who's responsible when they see the facts and circumstances. But some of the things they look at here, obvious ones are like you're an officer of the company or your CFO, your CEO.
They should know.
They should know. They have a duty to know. It's a fiduciary duty to the company to know what's going on with those things. Not only to the government, but to the company.
There's a whole lot of officers who would have no clue, though.
Well, true.
I mean, I don't want to pick on the chief marketing officer, but there's a pretty good chance.
Well, and they may not be. So that's why I say it's a facts and circumstances. But they will look to officers, people who are in financial meetings and are getting briefed on financial matters.
Yeah, if they're in the meeting, if the CMO's in there, the chief technology officer, or chief CIO, right?
So keep in mind in both of these, so an officer or a member of a partnership, in both of these instances, the IRS includes an officer or an employee, a member or an employee. So again, like I said earlier, this doesn't just mean you have to have a financial stake in the company. You could just be a bad controller.
Right.
And have this company arise. Or you could have a bad controller and have this issue arise. A member of the board of trustees, or I would say board of directors. Another person, this is a good one, another person with authority and control over funds to direct their disbursement. So, for example, in our company, we have an administrative account where we have small amounts of funds that are in that to deal with small matters.
Right.
Technically, anybody that's on that account, if they become aware, because this is the responsible person side of the equation, they have to be aware the taxes aren't being paid. So say I have a firm administrator who is aware that the trust fund taxes aren't being paid, writes checks from our administrative account to pay for
whatever,
our office supplies.
Whatever the IRS deems as a discretionary.
Technically, they're viewed as having authority to disperse those funds.
And so that person's liable.
Potentially. Again, none of this is absolute because it's a fact.
Still.
But what the IRS does is they cast as broad a net as they can among possible responsible persons, and they'll throw you all into a mosh pit and say, you guys fight it out. You guys all point the finger at everyone else, and you do the hard work of discovery and all that stuff for us. And once we figure out who the last man or women are standing are going to be, we'll go after them. But we're not going to do the hard work of dealing with you guys one-on-one. We're just going to interplead the whole thing. You're all getting drawn into it, and we'll let you fight it out. What happens is the ones who are responsible usually disappear.
Right, of course.
To somewhere.
Sure.
Underground for a while, and then you're fending for yourself. This is a happy message today. I can't believe.
It's a really important message.
But then the ones we've already talked about, payroll service providers, but then again, they're occasionally the ones causing the problem. PEOs. And then this is the one we already discussed too, responsible parties within the common law employer client. So if you're the common law, i.e. the state law employer in a PEO, you're still obligated to make sure that the PEO is remitting taxes for your employees, which is quite honestly an impossibility. So, and just to really quickly recap the willfulness, must have been or should have been aware of the outstanding liability and intentionally disregarded the law or was plainly indifferent to its requirements. Basically, ignorance.
Right, ignorance is no defense.
When there's a duty to know is not a defense.
No defense. Oh, Nate, what a horror story. Thank you so much for educating us.
So, folks should just be aware of this. Like I say, passive investments, going into business with a buddy where you're turning the reins over to them. Mm-hmm. These are all just potential.
Even if you're in a limited liability position, you could really take on a lot more
don't
risk.
Jump in and take over when things start going south.
No way, man.
Get a receiver or something. Don't step in yourself. That's the one thing. Until you know that the employment tax liability has been paid, because some distressed companies will still pay their employment taxes. And if you can do an audit and confirm, sure, step in and take over that one. But until you have confirmation that the employment taxes have been paid, do not go in like the Lone Ranger and
don't
save the day.
Wow. What a great lesson. What a horror situation. Well, closing thoughts?
Remember, trust fund taxes are different.
Yeah, exactly. You're a fiduciary. Infinite liability. Nate, thank you so much for the public service announcement today. Really appreciate it.
Yeah, just it was fresh in mind, so I thought people should know.
And it's always fun for me to recap my horror story with a payroll company. I'm still bitter about it years and years later.
You should be.
Right? It's theft.
Yeah.
All right. Well, don't let it ruin your day. In fact, create a beautiful day.
Thank you.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.